My pleasure and a privilege to be here with you today. We've heard a lot of positive things about the sector today and a lot of positive things about growth and opportunity in the sector. Normally when I hear the words growth and opportunity, they come together with the word investment. You need to invest in the first place as your business or an estate to take advantage of the opportunities that present themselves. A number of you will have the cash available to do the investment yourself, but probably more commonly you'll need the help of your bank or your financer to help with the investment in the first place. And it's against that backcloth that I thought I'd just give you an overview of how UK banking at large sees the landed estate sector, how it's treated it over the last few years, and perhaps more critically, how it will look at it over the next few years. I hope you find this of interest, and I hope I can hit the time frame for you. Very briefly, just before I start, I thought you might just appreciate a few words on me and what I do for Barclays so you can understand why I'm stood in front of you today. There's some details on me on screen. Man and boy is the phrase that most people use to describe the time I've spent with Barclays. I'm a banker by profession and training. I'm not a specialist in the sector at all, but I have worked alongside agriculture and the wider agribusiness industry for the best part of 20 years, and that hopefully means I've got some degree of understanding of some of the challenges and the issues the sector faces. National Director of Agribusiness is my current title. What does that mean from a Barclays perspective? Two parts of our operation that deal with the wider agriculture industry. We do have a national agriculture team which picks up the family farming business across all of the subsectors and deals with about 80% of our client base in the sector. The other 20% is picked up by our agribusiness team. You can see the areas we cover there on the screen, one of which is landed estates, which will perhaps explain to you what I'm doing stood in front of you today. I have operational responsibility for that agribusiness team across the UK and Ireland, and Graham McNaughton, who started the conference this morning, has specific responsibility for our client base in Scotland. So, how has banking treated landed estates over the last few years? Well, actually, that's quite a difficult question to answer because, as our first speaker this morning alluded to, there's very little data on landed estates available in the marketplace. There's no database for it. There's no standard classification coding for an estate. So it's actually quite difficult to get at base information about what's happened in the landed estate sector over the last few years. And that's true not only in Scotland, but across the wider UK market. But what landed estates are, and at their core, is agriculture. We've seen that on a number of slides today, and it's the same in the lending market. The majority of landed estate lending is lent to a business that at its core is agriculture, and that's typically where the classification sits. So a look at what's happened to lending in the agriculture sector is actually mirrored by what we've seen happen in the landed estate sector over the last few years. So what I'm going to pop in front of you now are some stats relating to the wider agriculture industry, and I hope that they'll give you a degree of confidence around the levels of support that UK banking at large has shown the sector over the last few years. These are the all-bank lending stats to UK agriculture. They're produced by the Bank of England, so they're free from any commercial influence, if I can put it into that vein. And what you can see is a really positive trend for the sector, with all bank lending rising from what was just over £9.3 billion at the end of 2006 to just over £14 billion at the end of 2013. Now, for the mathematicians amongst you, that's a 54.3% rise over that period. Critically, it's increased support in each year over that time frame. If I put the all bank lending to all industries on the graph alongside that, you'd see a very, very, very different picture. Agriculture is the only industry that shows this trend over a time frame. If I look at the Barclays book, our lending in the landed estates market mirrors this trend. And I don't see why we would be any different to the rest of the UK banking market. So, a positive story, and if you look at the stats that sit behind that graph, you'll see that that trend has continued. In November last year, we saw a record high for UK lendings to the sector. November typically is the high point in any year because of single farm payment coming in from December onwards. The December year-end position was actually 10.1% up on 2012. All bank lending to all industries actually declined slightly in 2013, so that really does buck the trend for what we've seen against the peer industry base. The February numbers, the last released by the Bank of England, show that the trend is continuing with a 7.9% rise year on year. And from our own perspective, whilst it says double digit on screen, we're actually up 15.2% year on year. So we're doing more than our fair share, if I can put it in that vein, of that increase. And that's a fairly common trend over the years on the graph that I showed you. So really positive news for the sector in terms of commitment from the banking sector, if you acknowledge that landed estates and agriculture are tied. So I hope that gives you a degree of confidence that the UK banking sector at large has been supporting the industry. The next question that typically follows that is, well, where's the money been going then? This is from an analysis of our own lending book. Sadly, the other banks wouldn't let me have a look at theirs. I did try, but they wouldn't let me do so. So this is from our own lending book, and I've grouped where the money's been going into some key categories. The message here is very simple. This is positive news, i.e. we're lending for positive investment reasons across all of these categories. They're in no particular order, and no one of these particularly outweighs the other, but they're all for positive reasons. So it's not funding losses, it's not problem positions, it's positive investment reasons as a generalisation around that increase in borrowing. So support from the sector for some good positive reasons is a really good place to be. So why is it then? Why is it that the agriculture and landed estates market typically has bucked the trend? Why has it been treated differently from the majority of other industry sectors in the UK? Well, there are a number of reasons for that, but I always come down to three in particular. Two of these very relevant to landed estates, and the third one perhaps more pure agriculture. But you are a low-risk sector. What does low risk mean to a banker? You won't be surprised to learn that we monitor the bad debt profile and our impairment profile in terms of lendings. And when I compare agriculture and landed estates with all the other industry groups, this sector stands out incredibly well. We lose far less money in this sector than we do in most others. That's a low-risk sector to a banker, and you won't be surprised to learn that low-risk sectors are pretty attractive to a banker in good and bad economic times. The sector typically is long-term in its thinking. Corporate Britain tends to think in fairly short timeframes, 3 to 5 year time spans, 5 years maximum quite often when you're dealing with a large-scale corporate. This sector has a much longer time frame around it, quite often generational in concept and its terms. That again has helped the sector buck the trend, as there were a number of long-term plans in place pre the start of any financial crisis and recession coming along that the banking sector at large has continued to fund and see through to fruition. So that's helped the sector buck the trend. And the third principal reason in my mind is that agriculture, which again we've accepted today is at the heart of a landed estate, is typically counter-cyclical in a recession. If you look back at all the recessions in this country post-war, you'll see that agriculture sits counter-cyclical in a recession, and a sector that's doing well in recessionary times again sits well with a lender. So three key reasons why agriculture has bucked the trend in my mind, and that fits very well with the landed estates market. So if that's where we are today, what does the future look like then? Do we see a change in that at all going forward? My own view on that is no, actually. The industry's enjoyed very good support from the UK banking sector to date. The dynamics from a banker's perspective are not going to change. They're there and they're set, and therefore I think the sector will continue to enjoy the support of UK banking at large going forward. I think from what we've heard today, we could probably accept that the market dynamics from a sector perspective aren't going to change either. We've seen demand for debt from the sector over the last few years. I don't think that will change at all going forward. I think we'll continue to see investment as you position your business or your estate to take advantage of the opportunities that are out there. So I think if you ask me the question, the dynamics of that graph we saw at the start will continue. We'll see continued rising borrowings going forward for the sector as more and more investment is done. As a bank, we recognise that trend. We've already been through the exercise with our own internal executive to ask the question, are we comfortable with that trend and are we happy to commit our balance sheet to support that trend? The answer to that was a resounding yes. So from our perspective, we're supportive of the sector. We're keen to discuss expansion and plans. I would say that standing here from Barclays, wouldn't I? But I actually think that applies to the UK banking sector at large, if I'm being perfectly frank with you. And I think if you've got a decent plan and a decent opportunity and you put your plans together properly, you ought to find support out there for it. And that probably leads me to the last point I just wanted to make today. What does that look like then? We've heard an awful lot of talk about banks not lending over the last few years. So if you're going to put a business plan together, what are we looking for? This might hopefully answer some of the questions. And looking around the room, there are a number of you that are probably in the same generational space that I am, and you'll recognise the mnemonic on here as a drink that perhaps you once had a few years ago, Campari. We still use this today. That mnemonic will tell you how long this has been around, and our parameters haven't changed. If you're putting a business plan together, 3 key areas for us in reality: management of your business. Who are they? What's their ability? What's their skill set? What have they done with the existing business? And critically, what skill set do they bring to the new operation you're looking to take on? Can your existing management team cover that, or do you need to buy that expertise in from somewhere else? Talk to us about the management of your business and your management team and how it fits together. That's top of the tree, and it's top of the tree deliberately, because that's the most important part of the jigsaw from a lender's perspective. Tell us about the performance of your business. Give us the projections as to how that's going to change with what you're proposing to add on to it, and work into that, how does that repay the borrowing you're asking for in the first place? The second part of the equation from our end, and the middle bit of this jigsaw around purpose, amount and repayment. Debt service is important to us. Just explain to us how much you want to borrow and where you're going to repay it from, so we can understand that. So management and debt service are critical to us. If those two are right, and only if those two are right, will we get as far as the bottom of this mnemonic here and ask the question, what's our insurance policy if we get it wrong? We like to think we never get it wrong. We like to think that we'll always get the first two right, but we don't. And therefore we do want some insurance or security. What is that? But it's at the bottom, and it's at the bottom deliberately, because the top two must be right first. Now, I'll make this point. This hasn't changed. I've worked for Barclays for 36 years. This is one of the first things I learned, and we still do it today. It is no harder today to get funding than it was before, particularly in this sector. If you have the right plan, there's every chance we will fund it. I hope that gives you a positive view of the sector. We certainly have one. And I hope that on the back of what you've heard today in terms of opportunities for the sector, you can go away with confidence that there's a funder out there in the market that will help you with your plans. Thank you.